I recently sat down with Ben Kizemchuk, an investment professional based out of Canada, to discuss the interesting framework he is using to understand the current economic paradigm. The past 15 years has seen reality happily tear through conventional economic wisdom. We had historic levels of money printing for years, without corresponding inflation in the economy, prolonged periods of negative interest rates, skyrocketing national debt that would create economic chaos any day now, but, for the time being, didn't even impact the government's credit rating all that much. $100,000 Bitcoin, etc., etc. Ben believes we should brace ourselves for even more weirdness, because the economic system is undergoing a fundamental shift in its very nature. He organizes his thinking into an easy-to-remember framework that he calls the 4F's. They stand for fiscal dominance, financial repression, fiat currency, and passive investment flows. Together, they describe a system where the federal government dominates economic activity, money transforms into something completely new, and financial markets become fully automated utilities. Sound confusing? Don't worry. We unpack each of these points in great detail during our conversation. Ben believes this transformation in the economy is not random, but is itself a transition phase, bridging today's world with the abundance economy of the future, ushered in by the dramatic productivity gains from cutting-edge technology. This was a fun treat for a finance and economics nerd like me, and I hope you will also find it stimulating food for thought. Hey Ben, how are you?
I'm very well, thank you very much.
Thank you for joining me today. I'm pretty excited about this. I came across some of your writing on Twitter of all places, and very curious and intrigued to get into this model of, I would say, the future, but it's almost like you're just like sort of trying to describe the present of our economic
Yes.
and financial systems in many ways. And we'll curious to sort of dig into it a little bit. But before I get into that, I have to ask, just because I'm in the media space now myself, you put out these like long essays on Twitter of all places, and I'm just curious why Twitter? Why not go to Substack? Like, is there a strategy behind this, or are you just the spirit hits and Twitter is the first place you go? Like, what is the strategy here for these long tweets?
It's
Yeah,
it's really just a question of the spirit. It's easy. It's right at hand, and that's just where it seems the audience is. I don't want to be dragging people here and there all over the internet to read interesting things. If people are congregating on Twitter, then I'm going to be putting stuff there for people to read. Yeah, just that simple.
that makes sense. Sometimes I wonder, we have our own site where we're hosting our sort of core content, and I'm wondering, is this really where the future of media is, or should we just dump everything onto the social platforms and see what happens? But anyway, I thought that was pretty interesting and curious. But what we really want to talk about is the 4F's. 4F's, F is in Frank, 4F's framework that you have been developing on Twitter and in your work, to sort of describe our economy and our financial system, and in many ways like our society, and where it's going. And I'm hoping we can kind of explain that for people. So I want to kind of break the 4 steps down as a way to start. And I'm gonna just start with a quote from one of these tweets that you put out, which gives kind of an overview of what this 4Fs thing is even about. And then you can kind of explain that a little bit before we get into fiscal dominance as the first pillar of this framework. So this is kind of a high level overview of the 4Fs. Their shared purpose is not to maximize growth, efficiency, or competitiveness in the traditional capitalist sense, but to reduce systemic volatility and automate economic coordination in preparation for a post-scarcity regime. This is what the 4Fs is for. Could you give us a little bit of a high-level overview of what it is that you're describing exactly, and also a little bit about how you came to this realization and sort of what sparked your building and putting together of these concepts?
Yeah, thanks. It's a really great question. So I'd say that the first thing that I wanted to respond to that with is that there's not some sort of a conscious effort here to build something purposeful. I'd say that to me, this looks more like an emergent behavior, meaning that this is just something that is kind of coordinating itself. There's nobody behind this all that's pulling the strings. There isn't some mastermind that's trying to build an AI future. This is just all of us working together And these features are just coming out of our production, so to speak, right? And in my view, what's happening here is that we are designing a system to reduce volatility. And I don't necessarily mean that in the financial sense, in terms of like we're going to reduce investment risk or something like that. I mean that we're going to reduce something even bigger. There's like a level up where it's not even, it is in some respect an economic sense of volatility, right? So that if we can stabilize the economy, if we can stabilize some of the cultural aspects of what we're getting into, then we can build something from which we can really propel into the next level of economic organization, right? We've moved, for example, from feudalism into like industrial capitalism, and then that kind of became like this kind of knowledge-based capitalism that we've been working with, I'd say, since maybe the 60s or even the 80s, really. And that the thing is that style of capitalism really isn't that different from industrial. But where I see things going next really is a very large leap that requires a new type of economic cohesion. And that's what that 4F's is. And you said it quite correctly before, that the 4F's is meant to describe where we are right now as a transition point coming into this new phase of AI and recursive capitalism and all those things that we'll talk about later on.
Right. So it's not a conspiracy. It's a sort of an emergent phenomenon.
No, certainly not a conspiracy.
Good.
Yeah.
So makes sense. So it's not an emergent phenomenon. Or it is an emergent phenomenon. It's not some kind of smoke-filled rooms, back rooms where decisions are getting made and things are happening.
It's too big for that. Yeah.
It's too big for that, for sure. So the 4F's, there are 4 pillars to this. So let's dig into those a little bit. The first one is fiscal dominance. And again, I'm going to read you a quote here from your writing. And then you can kind of dig in a little bit and explain what it means. What is fiscal dominance? So fiscal dominance refers to a macroeconomic regime where fiscal policy drives economic outcomes and monetary policy becomes subordinate or reactive. Through transfers, tax policy, industrial subsidies, and direct public investment, government steps in to perform what the private sector no longer reliably delivers: a sustained marginal boost to output, income, and employment. This goes beyond countercyclical stimulus, becoming a structural necessity, especially in an environment of aging demographics and automation. This is a pretty fundamental shift, pretty non-capitalistic, if I may say so, kind of shift that you're describing in our system. Can you explain a little bit more what you're saying?
Yeah, sure. So the idea of fiscal dominance is really one where the government, and specifically the Treasury, plays a greater role in economic growth than we've all been used to, right? And I'll say that, I'll contrast it with where we've been and where we are now, and I think that might help like explain it a little bit better for your audience. So, post 1980, we've been in this big credit cycle where interest rates have been going down and down and down, okay? And that has enabled a huge amount of economic growth, okay? People, for example, could refinance their mortgages, take money out of their house, realize equity and things like that, and use that money and spend it. And that was a very large driver of growth for a very long time. But then we got to, near zero in interest rates, and that whole train kind of came to a halt. And we had to figure out a different way to grow. Well, the good news is that money can come from one of two sources, right? Money can either be created by the government, or money can be created by private banks in the form of lending. And so sometime after the global financial crisis, we started to switch, or the pendulum started to shift back towards government money creation as a primary source of economic growth. Now, the economy doesn't really care where the money's coming from. As long as the money is coming, the economy will grow. See, that's the key thing here, is you want to make sure that that money keeps flowing. As long as the money is flowing, the economy is growing. As we've shifted more and more towards the government in terms of the source of money creation, the economy has changed, right? As we haven't been so reliant on banks anymore to fund economic growth. And so in that quote that you're highlighting here, I'm simply making the point that government is becoming a greater source of that economic growth. And that tied in with that idea, well, how is the government growing the money? Well, there's different forms of it. There's subsidy payments. Obviously, in some respects, tax policy comes into that. A large and growing chunk, I believe, will be transfer payments. That's government directly sending money out to individuals, paying for their expenses. And the kind of last big part of that, and the part that is getting much bigger, in fact, over the last few years, has been the payments on the national debt. All of that debt is held by somebody out there. And when interest rates rise, the payment on that debt rises, meaning that the bondholders, whoever they may be, get more and more interest payments. Well, of course, they have to do something with those interest payments. They could continue to save them, or they could spend them, or they could take that new money and plug it into the stock market, for example, or crypto or real estate. But the fact remains that there's more and more and more of that money coming out, which means that it has to find a home. And so that is one of the biggest shifts that this fiscal dominance framework has introduced, is that it's producing a lot of money. And it is producing so much money, in fact, that in my opinion, it is swamping out whatever the Federal Reserve can do to try to control it. You see, again, moving back to that 1980s until global financial crisis period, the Federal Reserve could increase or decrease interest rates to try to either expand or contain the economy. And we've all come to know it as such, and we've all come to be very reliant on that idea. But I think what was demonstrated when the Federal Reserve increased interest rates in 2022 by 5% in a year, everybody was expecting a recession. Everybody was expecting that should have contracted the economy because that's how things worked. But that's not how things work anymore. When the Fed raised interest rates most recently, all that did was it increased the amount of money coming out of the Treasury in the form of interest payments. And that money, as I said just a moment ago, goes out to the public. And I think that is a preeminent example of fiscal dominance, right? The Fed, the monetary levers that they pull don't work anymore. They are no longer dominant. Now the thing that is dominant is the federal government and fiscal spending.
Do you have a sense, and it's okay if you don't, but off the top of your head, of like what those interest payments are per year that coming out of the Treasury? Like what was it, like 400 billion?
Yeah, sure. So one of the things that I do to keep an eye on what I think is going to happen with inflation is I look at something called the weighted average coupon. Now that's a mouthful, but basically what it means is if you look at all of the debt together, and you look at how much interest is being paid on all of that debt together, like if it's all one big portfolio, if you go back immediately after 2020, that interest rate was around 1.89%. And since then, it has floated up to about 3%. My view is that with this new spending bill that's just been passed, I think that number is going to start floating up to about 3.5%. Now, I don't have an exact time frame for that. It depends on how much and when the new debt payments, or sorry, the new debt advisory, the TBAC, it's called. We'll give some details on that in the next couple of weeks, and they'll be able to tell us what the spending plans, what the debt plans look like for the government. But my hunch is that we're going to head up to about 3.5%, which should in turn kind of move inflation up in that direction as well.
Right. So we have a roughly, let's say, I don't know the numbers off the top of my head, but let's say we have a roughly $30 trillion economy, and we have roughly $30 trillion of debt. Correct me if I'm way off here. I'm just spitballing. And so if 3% of that is getting paid every year as new money into the system, that's like, I don't know if this exactly works, but that's like that's a lot of the GDP growth that you want is just coming out of those interest payments basically into the economy. And so the Fed raising rates, which is supposed to slow down people borrowing money to buy houses and do all these kinds of things, almost doesn't matter because the raised rates force the Treasury to pump more dollars into the system, which is like a significant percentage of GDP now. That's
That
basically.
that's exactly right, and that's something that I would highlight as well in another writing that I had, where um, because the debt is larger than GDP and is going to become even larger than GDP. Every you can think about it this way: every 1% increase in interest rates will add 1% to GDP. That's just the math of it, right? And so if right now we are paying somewhere around 3% on the total value of that debt and it floats up, well, you think about it that there's going to be 3 to 3.5% more new money printed this year, next year, and so forth, right? And that will tend to, that's why I believe that it's going to tend to set a floor on inflation of whatever that number is going to be. So if that total volume of that money starts increasing, then that's going to flow into the economy, and that kind of sets the new floor on what inflation should be. And it'll hover around that level, but it should get around there. That's not a new concept by any means. Like we've been there before. Looking at some economists from the past, such as Fisher, for example, has written about this. It's just we haven't thought about it this way in quite some time.
Right. I mean, we're kind of in, I guess, uncharted territory with the debt being such a large percentage of GDP, and it's interesting to see how that sort of changes the way things work structurally. You mentioned that the old way of doing things, where the banks were creating most of the money by lending to, let's say, private, maybe entrepreneurs or people trying to buy homes or other assets, like that lending is where most of the money was getting generated. So it was happening in the private sector, and the government was kind of there in the background, there to regulate things and make sure things kind of be a backstop if things went bad. But basically, it was the private sector that was generating the new money and generating the economic activity and coordinating everything, all that kind of stuff. I'm still why if you mentioned this before and I missed it, I'm sorry, but like why does that no longer work? Like why can't we keep doing that? Like uh why is that game ending?
Yeah, that's a really great question. So it's not that the game has come to a full stop, let's say, right? Private money creation, which is money created by banks, is still larger than government. Okay, it's just that that since the global financial crisis, some point in the mid 2010s, the pendulum started to shift back. And I think that's because there was a lot of regulation put on the banks after the global financial crisis, some of which, policymakers are trying to remove right now. For example, the SLR, which is a supplementary leverage ratio. That's kind of Scott Bessent, the U.S. Treasury Secretary, had described that as a corset around banks currently. And they want to remove that so that would enable the banks to lend more freely again, as they did before the global financial crisis. So, for example, if that were to happen, you could see an increase of credit creation on the banks and so forth. What I think may still push for fiscal dominance, even if we end up in that world of banks going back to lending the way they used to, let's say, is that government spending since 1985 has been growing at around 5.5% per year, pretty much on trend every single year. Now, the thing is, if you continue that growth rate over and over and over again, you kind of get to a point now where the government spending becomes so large that it will continue to swamp out GDP, for example, right? And so government is on this kind of trajectory where that's the case, where fiscal dominance is kind of baked in, as I've said before, in other places. And to try to remove that, to try to take that government spending out of the equation at this point, in my view, would be the closest thing you could get to like a economic cataclysm. Like, if you start to take that government spending out, you are physically removing dollars from the private sector. And there is nothing more contractionary or recessionary than removing money from people's wallets. It would just be a dark road to walk down.
Totally. We're in a way we're like hooked on the fiscal stimulus in some sense is it's literally got its hooks in us in some sense. Um, uh, you had mentioned as part of fiscal dominance in one of the writings that you did that there's been a lack of appetite for investment, or I guess private players are not seeing good opportunities for productive investment in the private sector, and that is part of the reason, or that is happening at least simultaneously with the government spending becoming a bigger factor in moving the economy. And I remember several years ago in my previous job, I was looking at the balance sheet of Google, and I was like shocked that they had like $100 billion of cash and treasuries and basically cash equivalents on their balance sheet. I was like, $100 billion, and this is after all the back then they had those, like, they were sending balloons and they were doing self-driving
Yeah.
cars, and like this is after all of that they still have $100 billion in cash, and it's like, why uh like why is that, like why are these smart um corporations filled with intelligent people looking to generate returns on investment, why are they not able to find productive investments in the economy?
Um, well, I, I I think it has to. It's kind of a self-referential type of a question, right? You have these like huge quasi supranational sovereign corporations, really, and you have literally like a handful of them, or let's call them like 10 and under, right? Not to point directly fingers at the Mag 7, but essentially that's what it is. And then you have the rest of the S&P 500, the S&P 493. And if you look at the earnings growth, for example, as one of these metrics that kind of highlights this, we're coming off of year-over-year earnings growth for the Mag 7 of around 28%. So they've grown their earnings by 20% over the last year. If you look at the rest of the companies in the S&P 500, it's been what, like 4% growth. And my view is that these huge corporations have not only baked in these kind of like cash flow flywheel effects, right, of just having very asset light but very profitable businesses, but they have become so integral to the function of the U.S. as a state and as a culture that they are seeing the lion's share of profits, and that they essentially have become, in my view, something that I'm calling the enterprise-owned state, right? So in China, for example, you have these things called state-owned enterprises, right? In the U.S. and Canada, we have them as well. We just, we call them crown corporations in Canada. The post office is a great example, right? And usually what we do is we take businesses that wouldn't survive on their own, but they're very important from a societal perspective, and the government will kind of incubate that business. So the post office, right? In China, that concept goes a little bit further, and you have like full, businesses that are, serving private sector, but they're owned by the state. In the U.S., I think you have the opposite. I think that you are developing this kind of new type of idea called an enterprise-owned state. And that is a company that is so embedded in the framework of policy and policymaking that it acts almost like a conduit of U.S. policy. And it shares in the revenue and growth from those efforts, from those policy efforts. The best example I can think of right now is if you remember back to when Trump and Musk were having that very public kind of rift over Twitter, and Musk was making reference to grounding the space shuttles, right? And those aren't just carrying, like communication satellites for you and I. Like those are carrying things that are important for national security, right? And so, Musk was really, hitting them where it hurt if he were to follow through on that. But it also highlights the degree to which the U.S. government needs and channels and kind of is integrated with the private sector, right? Like the U.S. space program is essentially being carried out by SpaceX. It's a private company. And so that's what I mean by the enterprise-owned state, where you have these companies that are effectively integrated into the fabric of the national apparatus. Okay. And if you ask where is the innovation happening, The innovation is happening kind of within those bounds. It's in that sandbox. And anything that is close to becoming of national importance gets co-opted into that sandbox, right? If you look at the building out of all the data centers, et cetera, that's a matter of national security, I would argue, right? And so that is also part of this framework. That's where the growth is on the real estate side of things, right? Chips, for example, are another avenue here to explore. So we do have a lot of innovation happening. We do have a lot of growth happening. It's just being concentrated in places where there's heavy government involvement.
And basically everyone else is just kind of going through the motions to some degree, meaning like it's like all of the is what you're saying, that the innovation, the opportunities for really high productive investment is sort of being funneled into a small set of like favored institutions, favored corporations, and everybody else like would really struggle to get access to those same opportunities. Is that?
I think that's a pretty fair way to characterize it. I mean, I don't want to boohoo on the whole idea of entrepreneurialism, right? Because I do think that is still the lifeblood of it. But the question is, who's incubating that? Yeah. Where is that happening? And how quickly are those ideas being co-opted into large, sovereign megacorps? Yeah. As opposed to, for example, going through an IPO and getting listed on the market and commercializing yourself.
How quaint. How quaint.
Yeah, it is almost quaint in a way, right? You could argue that some of that may be happening in crypto. I don't know that it's regulated enough to be of like a societal importance at this point. I mean, obviously there's massive progress being made without a doubt, but I just don't see, at this point in time, I don't see that kind of, it's not being co-opted yet into the general public's. Like the general public is certainly aware of it, but it's not like a daily technological use case, right?
Yeah, I mean, we could argue there are efforts being made in that direction with like, I don't know, Bitcoin ETFs and things of that nature, but it's,
it's in progress. We're not there yet.
Right.
Yeah.
That's the process. Like with every technology, as it starts to appear like this is going to become central to the modern way of life, it sort of gets funneled into this like, I'm trying to avoid the word oligopoly. Maybe we'll get to that, but later. But funneled into this like this basket of enterprise zone states. And you have a quote here. I pulled it out about the enterprise zone state. I'll just read it real quick, and then let me know if there's anything in that you want to address that you haven't already. But we're not entering a socialist economy. We're not reverting to capitalism either. We're moving into something new, an enterprise-owned state. In today's 4F's regime, the state is increasingly structured to serve and stabilize large firms. It supplies aggregate demand via fiscal dominance, price stability, and capital flows. These flows are captured disproportionately by large, index-heavy public companies, those best positioned to perform scale, narrative, and system stability. So we're going to get into financial repression and passive flows and what you kind of mean by that. But that's basically like the S&P 500 and then the Mag 7 within that. Everyone's like retirement, 401ks, everything is kind of getting automated. Money is just sort of funneling into these equities, and it's almost like on a faucet. It's like on a human decisions aren't being made to make the money move in that, and that just increases the power of these institutions, etc.
One thing I'd add there to give that excerpt a little bit more color is that I don't think that this is an extension of capitalism. It clearly isn't. To the degree to which there's intervention by the state in the markets, like this cannot be capitalism, okay? But it's also not socialism. I think that's the main critique, is that, the S word is a very touchy kind of subject. It's, nobody wants to go there. But I don't see this as being a socialist framework. Like, if you have these large mega corporations that are essentially running things hand in hand with policy, like the means of production are not being owned by the state. All right. Like it just quite simply ends there, like this progression into like this kind of like automated luxury communism stuff. If we're talking about the extension of AI and all this stuff later on, like this isn't at all what we're going through right now. But this is also not corporatism. This isn't some sort of like integration or like state capitalism either, right? And I don't want to get too into the weeds about what these definitions are, like, because they do mean very specific things. But this is really its new own thing, right? This is the state and corporations working together in a way where they're like this. The corporations are becoming a higher and higher. They have greater and greater agency in how this capital is being deployed. One last thing on that topic that I'll mention is that all you had to do to understand that this was going to happen was to just pay attention during the Trump inauguration and look at the days, right? Look at who's up there with him. He did not choose post office workers to be up there with him. He didn't choose farmers or doctors or teachers, or he chose the CEOs of public companies. Okay, like there is a very big message there, particularly like the messaging factor of the entire Trump admin is really what that admin is about, in my opinion. The man has become an icon from using symbolism, etc., from the reality TV world. And that did not stop when he stopped that show. Like, that is still happening. And so to understand the imagery of what we saw there of those public company CEOs, like it's not even that he chose private company CEOs. He chose public company CEOs to be up there. And I think that really speaks to that integration in a very specific way.
Totally. And I think you had this in another one of your posts. Kind of the way these things fit into the 4F's is that the fiscal policy through the fiscal dominance, because of fiscal dominance, fiscal policy becomes a bigger and bigger driver of the economy, and fiscal policy becomes the revenue of the enterprise-owned state, or these corporations, I guess. And then the corporations become the mechanism by which like wages are then funneled to the population.
So I mean that's just something. If you look at, there's something called the Kalecki-Levy profit equation, which is you just rearrange the formula that makes GDP. And essentially what that boils down to is that corporate profits are a function of government spending. Okay. Like, I'm not going to get into the actual math of it, but I invite your audience to look it up on whatever your favorite, AI is, and learn all about it. But essentially what it means is that government spending in a very real way channels into corporate profits, right? And so if that government spending is now the dominant feature of our economic growth, and government spending is not just in the form of transfer payments to individuals, but is also effectively channeled into corporations, who then channel that into wages. Well, the primary source of those wages is government spending, right? So just to give your audience a little bit more color on the root, the plumbing, if you will, of how that works.
Totally. I don't know if you caught this, but we interviewed recently another person who's quite prolific on Twitter, Kumar Tanguru, and he has this thesis he's developing where he's sort of looking at the public pension funds and how much AUM they have under management, and then how they funnel that into private equity companies, and how that's in kind of the hundreds of billions to close to $1 trillion a year, and how that sort of also creates a kind of influence of government in the real economy. But that's
I would agree with that. Yeah,
it's coming from various different angles. The government apparatus is just so expansive and so large. Okay, we spent a lot of time on fiscal dominance, but I think that's like a big chunk. We'll try to get through the other ones as efficiently as we can. Financial repression. I'll read another quote here. Financial repression, defined as the suppression of market interest rates below the level that would otherwise prevail. A profit stabilizer. It aligns monetary conditions with fiscal support to create a macroeconomic environment where earnings are sustained, volatility is dampened, and growth becomes more predictable. All right, so that's a little overview of financial repression. Can you explain, in simpler terms, what is financial repression?
Yeah, sure. So financial repression is just the government intervening into financial markets to try to create an outcome where interest rates are lower than they otherwise should be. All right. Now, this is not new. We've done this before. We've seen this before plenty of times in history. Um, and essentially, what I think is happening today is not so much that the government wants to push interest rates lower, notwithstanding Trump, I think, wants, to drop rates by 3%. I'm not sure if that's going to happen. But when I'm talking about financial repression, what I think is underway is that it's not that that we're going to try to push interest rates any lower than they are today. It's that the economic growth that is underway today and that is coming, even though a lot of that is nominal growth, right? That's just inflation pushing up, but that's going to want to push interest rates higher. And so if we can just put a ceiling on interest rates, not necessarily put them lower, but if we can just put a ceiling on interest rates, then what we can do is we can create a gap where the economy and inflation, GDP is somewhere up around here, and let's just use easy numbers, 6%, right? And if we can pin inflation, if we can pin the risk-free rate, if we can pin government interest rates somewhere here around 4%, well, then there's a 2% spread in there. And anytime that there's a spread on anything, you can bet that somebody's going to be taking advantage of that. Right. So all that would happen in this circumstance is that you get a flood of people going to banks trying to borrow at 4% or something like it to invest in whatever the economy can produce that's doing the 6%, and they'll earn that 2% spread effectively risk-free. Right. And so financial repression is a way to encourage private sector growth. It's also a way to encourage a lot of lending to happen. Okay. Now, I'm not of the view that this is necessary. Like, I don't think that higher interest rates, given the fiscal dominance framework, higher interest rates are not a bad thing. Higher interest rates are fine. They're just a reflection of economic growth that's happening. But the current set of policymakers that we have, in my opinion, they're still operating in this 1980s world where they still think that credit dominance is a key feature of economic growth. And from their perspective, they want to ensure that interest rates are lower. See, if you put yourself in their shoes, you've been doing this your entire life, you were born and raised in a credit cycle economy, then you think that the solution to high government debt is to keep interest rates low. And so that's what you impose upon the market. I don't think that's necessary. I think that the economy can do just fine with rates where they are. I mean, mortgage rates at 7% right now, and the economy is still functioning, right? So the financial repression aspect, what I do think is going to do, and that is beneficial, is that I do think that would reduce volatility in the market, right? If you create that spread, like I mentioned before, you can encourage a lot of private sector growth. Banks will likely enjoy the fact that there's all this government spending happening that effectively de-risks their lending, right? If the banks know that all this money is flowing into the economy, then they probably have some greater assurances that the companies and the people that they lend to will be able to service their debt with all this new money flowing in. And then that should open more lending. We are seeing indications now that we're moving towards that financial repression idea. A couple of ways that that's already been communicated is through stable coins, for example, having to now own government debt. There are conversations underway to expand bank lending by removing what's called the SLR, the supplementary leverage ratio. That's that corset I mentioned a few moments ago. If you remove that, then there are some suggestions that bank lending could move upwards of $600 to $700 billion of new lending, but that's a huge amount. Okay, with the amount of the concern of policymakers right now is that with the amount of new spending that's happening through the budget bill being passed, and you've kind of forestalled the debt ceiling, they're kind of, or you might think that they would be a little bit worried that interest rates would float up, and so they want to kind of preempt that and get in the way of that and keep a lid on rates where they are now.
Yeah, I mean that does kind of make sense to me also, in the sense of like if you're assuming that all of this government spending is baked in, and uh, plus people are trying to do things that expand credit growth so much in the private sector, you have so much money flooding in. Like, how does that not be inflationary? So I can kind of understand. But then wouldn't that? I guess what you're saying is that would the natural thing to do then would be for rates to sort of go higher, and the policy folks are coming in and kind of stopping that natural process, um, because high rates is seems to be like it would be a bad thing politically or economically or for whatever reason.
Yeah, in their view, high rates are still contractionary when they aren't actually. But again, that's moving back to that Fisher idea I mentioned before, where for example, like the 10-year government bond rate should kind of match your nominal GDP growth, right? It should float within a range of there. If you look at the very long-term history of government of that government interest rate, it's kind of in alignment. Now that alignment drops out after the global financial crisis, after the central bank started to deploy a whole bunch of new tools to try to manage the economy. But my view is that that's coming back into alignment now.
So in your post, you had mentioned that financial repression has kind of two purposes in a way. One is what you mentioned, that it spurs more private investment because of that spread that you were talking about. And then the other thing is that because so many we just live in such a levered economy that everybody has so much debt on their balance sheet, whether it's individuals who have a mortgage and car loan payments and credit cards, or whether it's corporations and businesses that have all this debt. It's like there's just so much debt in the economy that there's a sense that we're fragile to an increase in interest rates, and by capping it in this way, you kind of sort of stabilize the earnings and sort of stabilize those kind of things. So those are, perhaps I'm just summarizing what we've already said, but those are kind of the two purposes of financial repression, kind of in this environment. Is that right?
Well, I don't think that the private sector, you and me, I don't think that we're particularly fragile to that. I mean, we've seen a tremendous deleveraging of the economy from households. That is to say that, like, we're not tremendously indebted the way that we were going into like the global financial crisis. Now, the financial repression does still reduce that volatility, anyways. But I don't think that we are in or have been anytime recently in a very vulnerable state as operators in the economy. And again, I would just point back to the 2023, when everybody said the housing market was going to absolutely collapse, and here we all are, and everything's fine. I would even mention, and this is a very, very new data point, that we are now starting to see a positive inflection in commercial real estate lending, right? So if you go back into the shoes of your average 2022, 2023 bearish investor, the biggest boogeyman on the block was commercial real estate. That was the thing that was going to obliterate the economy, and we would never be heard from again. And yet we've made it through. And now we are actually starting to see that type of lending accelerate higher. And literally just in the last 2 weeks, I've noticed this popping up on the weekly lending reports that are sent out from the Fed. So I think like that's a really, really early like bleeding edge indication that we are on the cusp of what I believe is going to be a very large economic boom. The fact that we've now moved to a point where commercial real estate is now going higher. But it just goes to show, I don't think there's a lot of fragility out there. I think quite the opposite, that the economy today is possibly more robust than it has been in the last several decades.
Yeah, you're right. Actually, I do remember people freaking out about commercial real estate because so many more people were working from home and interest rates had climbed up higher, and all of these things that there was all just this spare capacity not being used, and we would have a big problem in commercial real estate. And
Yeah.
that didn't I didn't even realize, but that didn't really materialize. Why can you explain through this framework why you think that didn't happen? Is it just because the government somehow somewhere stepped in and restored the
Well, I
balance
do
sheets?
think,
Or
I do think that a lot of it was to do with the increase of government interest payments. Who owns a lot of that government debt? A lot of the banks that were on the flip side of the commercial real estate, all of a sudden their inflows are increasing. State inflows as well are increasing off of that. Right, states own a lot of government debt. I also think hand in hand with that, the Silicon Valley Bank blow up didn't help, obviously. But the fact that in the aftermath of that, government bonds were kind of given, full. I can't remember exactly what the terminology was at the time, but they developed a new, acronym that they used. And it essentially meant that the banks could carry all the government debt at full value on their books. So that certainly helped as well. So it's not without some efforts that we made it through. I mean, I don't mean to suggest this was all very easy and like it was all done in an instant, but the economy was steered through in that circumstance in a way that resulted in where we are today, where we've no recession and the economy is still growing quite strongly.
makes sense. No, but it's like the banks will not be left to their own devices. Like the government will come in and try to steer things through if they see a wound or if they see a problem, and that's I mean that's not necessarily a bad thing if you're just thinking of it as an individual who's trying to make sure society is stable, etc.
But you don't want a system where where it's the inverse of that. You want the system to fix itself. That's the whole point, right?
Totally. Yeah.
Munger's very famous quote, "And then what?" Right? Like the banks, the system isn't just like the main job of the system is to perpetuate itself.
Right.
That is the only job of the system, is to make sure that it can survive another day. And by any means necessary, that's what happens, right?
Totally. All right, let's get to fiat liquidity. I'll read another quote just because that's our little pattern here. But fiat liquidity is no longer just a monetary instrument. It is a programmable economic resource. Imagine money that expires or becomes non-transferable or non-hoardable, for example. As fiat liquidity becomes more programmable, its role shifts further from a passive medium of exchange to an active tool of economic coordination. This was, I would say, the one out of the four that I just didn't see coming. The other three you hear a little bit here and there, and I've been following the cryptos. I used to follow it a little more closely several years ago, but I didn't see this idea of like programmable money being like a real. You would hear the Ethereum folks and everybody talks about it. Everybody in that world is excited, but like you're saying that this could be a real thing. Could you talk a little bit more about fiat liquidity?
Yeah, sure. So we got our first kind of idea of programmable liquidity in 1971 when Nixon closed the gold window and all of a sudden the US dollar floats. Okay. And how did that become programmable? Well, you could now expand or contract the money supply through policy. You didn't have to expand your gold reserves. You didn't have to get more of whatever asset was backing your currency. You could, by the stroke of a pen, expand or contract your money supply. That is the first issue, this first instance of being programmable, right? And we've had that with us since then. Now, I would argue that we are on the verge of a new type of money, okay? So part of what I believe the Genius Act and stablecoins are all about, stablecoins they're not just, it's not just money in the sense that you can transfer this from one person to another. These are like essentially mini contracts, okay? And depending on whatever protocol you want to use, you can make those contracts do all sorts of things, okay? Now, the other side of this is you want to look at what central banks around the world are writing about in respect to central bank digital currencies, okay? Now, I know that we've said, or the US has made clear that they don't want any central bank digital currencies, but there's a lot of research being done all around the world on this subject. And I would argue that if you're reading about it in one place from a central bank, it is definitely being thought about in another central bank. We're in this kind of framework of mono policy where the G7, the G8, they all get together and they all kind of decide what they're going to run all together, right? And so you're not going to get one without somebody else also doing that or something like it, right? And to that extent, I read a very interesting paper 2 weeks ago that was published by the Bank of Canada. The Bank of Canada has been doing a tremendous amount of research on central bank digital currencies. They've been publishing at least once a month on the subject. The latest one was a big change. The latest one, they are looking specifically at programmable currencies. Now, they're using all sorts of different language, but essentially, the currency is programmable. So imagine this. Imagine you are in the depths, or you are about to enter a recession, and the government sees this, and what is the government's typical response to a recession is, let's create more money, let's get the wheels greased, and let's get this economy moving. The problem with that historically has been, well, once you put that money out there, the only way to get it back is to tax it, and nobody likes that. You're going to get kicked out of office. And then you get this really nasty side effect called inequality. You produce a lot of money, and you may give it to the intended recipient at the time that needs it, but essentially, at the end of the food chain, it gets hoarded by somebody and locked away in a vault, and you end up with this inequality problem. So what if you could now program money so that in the next recession, you can distribute this money, but it expires after 6 months. So you have to spend it now. If you don't spend it now, it's like you never had it, but it expires. So no matter where it is, after 6 months, it's gone. Okay. Or you could say, well, what if we produced this money that after it gets, we give it to whoever we want it to go to, but then once that person spends it, then it's gone. Right? So then it becomes almost non-transferable. So if you can eliminate or disentangle the hoarding aspect from the money creation aspect, if you can program money to do new things like that, then you can have new tools that will and can help the economy grow, but you could try to address things like social inequality in new ways. And I'm not trying to suggest that I have the answer and that this is what we should do, but that I do think that this will be experimented with. I don't see why policymakers wouldn't try to do something like this. You and I we're young guys on this call, and inequality is a very large problem in the eyes of millennials. And we're maybe 2 elections away from a millennial president, perhaps. Is this something that we might see in our lifetimes? I'm not going to say no, right? So when I'm talking about programmable money, this is a game changer. It is new. It can very materially change how the economy works. And it is something that is being talked about now. And that's just even beyond the whole MMT implications of government spending and money printing and all of that. So we're essentially taking that core idea and really pushing that idea in a new way.
Yeah, sounds a little chaotic to me, to be honest. It's like you'll read about these things about how money has to serve these various purposes, like unit of account, medium of exchange, store of value is very important. And what you're saying is if you could program money, since it's all digital now, you could like pick and choose which function you want that particular unit of money to serve.
Yes.
And that's very interesting and intellectually interesting and things like that. But like, if my money is going to expire in 6 months, doesn't somebody on the other end have to be willing to accept it in order to like transact with me? Who knows? It's difficult to predict whether those kinds of things, what kind of dynamics that'll lead to. But totally, if I have expiring money, I'm going to want to spend it as fast as possible. There's like no reason to hoard it, invest it, or any of those kinds of things. But
yeah. Well, I would think that if we were to enter into that type of an economy, you have all sorts of different, like you're already at that point, in my opinion, you'd already be so deep in a post-scarcity economy that the way that you and I are talking about money is no longer the way that those people would be understanding the money that they have. That relationship to scarcity, whether it be money or employment or wages or time even, that's all very different in post-scarcity. But we'll get there. Let's stick with the 4F's for now.
Yeah. It's almost like it's not money, it's like coupons, because the supply of things is okay. But we got one more left before we get there.
Okay.
Bear with me here. Hopefully these quotes aren't burdensome, but I'm thinking
No, this is great.
we'll section off the things, and these quotes are a nice way, a nice little section break kind of thing. So passive flows. This is the last of the 4Fs, where capital markets were once driven by discretionary investment decisions. They are now increasingly dominated by index-based investing, algorithmic trading, formulaic asset allocation rules. This, for example, target date funds and rebalancing mandates. This shift automates capital coordination, suppresses discretionary volatility, and creates a baseline demand for financial assets that is largely indifferent to near-term fundamentals. All right, passive flows. Can you explain what that's all about?
Yeah, so the idea here is that increasingly money is being managed in an automated way. Okay, so the easiest example is that if somebody is saving regularly in like a 401k retirement account, normally what would happen is that money goes into that account, okay, and then becomes invested, usually on or around the the 23rd day of the month. Don't ask me how I know that, but generally in and around that day, okay. And it's probably going to find its way into an index tracking product, okay. That means that it's probably going to end up in something like the S&P 500 or something very much like it, right? And when that money goes into that type of an investment framework, there's nobody sitting there saying, oh, well, I think Apple is going to have more cash flow than Microsoft this quarter, so we're going to buy more Apple. None of that type of fundamental style analysis is happening. The only thing that's happening is the index sees that one company has a much larger market cap than the next, and so that larger company gets a disproportionately larger amount of that dollar than the smaller company. And on the surface, if you do that, that's kind of innocuous. It's not really going to do too much. But if you keep repeating that over and over and over again, you're going to introduce a feedback effect into the market. If you're constantly bidding up more of the larger company than you are of the smaller company, then you're going to be creating this feedback effect that helps cause the larger company's price to increase more and more. And I'd say that that's where we are right now. About 50%, just over 50%, depending on who you ask, of the market right now is kind of in these index tracking style products. Based on some very credible research out there, if you were to continue this over and over again, within the next few years, you could see some pretty dramatic effect on the stock market. That would essentially be causing those largest stocks to increase almost in a hockey stick fashion, nearly exponentially, versus the rest of the market. Now, of course, that would drag up the index prices quite considerably as well, since those companies would become a larger and larger proportion of the index. The real underlying idea here, though, is not so much that, well, it is important that those companies are getting a disproportionate amount of the flows and they're getting much larger. That gives them all sorts of kind of leverage with which they can operate. It becomes easier as a company the bigger you get in terms of the things that you want, right? But the fact that this is all becoming automated is also a very, very important aspect of this, right? That we've just decided to give over the price discovery. Markets used to be about this idea of price discovery, about resource allocation. The whole reason for going public was that so a company could get money with which it could then deploy some sort of growth project with, right? And it seems to me like we're moving further and further away from that price discovery mechanical aspect of the market, and it's now become more so of a utility, right? And one way that I look at that is, if you go back to like the early 80s, about 30% of households had some sort of investment in the market, and that's up now somewhere between 55 to 60%, right? So we are now increasing the scale and distribution of ownership of the market, right? Now, the one really interesting new piece of policy that came out was, every baby gets $1,000 investment in the stock market. So with that, you are what, one or at max 2 generations away from 100% investment in the market. And so I've developed this concept that's called the stock market economy, which is meant to reflect this idea that the economy and the stock market are no longer these separate and distinct things. They are effectively becoming one and the same. They are effectively becoming a utility as opposed to this kind of discretionary wealth capture and price discovery device. This is now becoming a public function of everybody in the economy gets a piece of the stock market, right? If we go back and we look at the main plight of millennials over the last few years has been this concept of affordability, right? Millennials have been sort of priced out of the housing market, right? They have been priced out of the massive run-up in stock gains. They have very much been priced into crypto, but that's not really been in huge dollar amounts the same way it has been with other parts of the economy. And so what I see happening here is in my opinion, we're in the early kind of stages of really making a public ownership of the market will become an explicit government policy. I think that what we could see here is these index. See, part of the issue is with these the Mag 7 companies, for example, getting grown to such a large degree that they could potentially become a very real risk for the market. Because if something were to happen to them, something exogenous, for example, you could torpedo the market, right? If everything gets kind of concentrated there. And so the government may want to step in and own some of these companies, right? But then what do they do once they own some of that? Like the only thing big enough, the only entity out there big enough that could potentially forestall a market crisis if you were to get to such large amounts of such high prices would be the government. But then what does the government do once it buys those things? Well, what if the government will take some of the income from the shares, right? Those shares represent an economic interest in those companies, and they're entitled to some of the profits. So what if the government, as shareholder, takes some of those profits and redistributes them to millennials who had a big issue with affordability and bridging the gap, so to speak, right? So I don't think that this is so far off. I don't think this is like some unimaginable idea. I just see this as the eventuality of, if you continue this passive investment inelastic market kind of trajectory, where do we end up? And then what question means we're not just going to let the market completely fall apart. The government steps in and we develop now a public ownership, right? And I think not to get too heavy into sloganeering, right? But the idea of do you want companies to buy back their shares, or do we want to buy back the companies? Right? This idea, this very millennial idea of collective ownership, like these companies belong to the national interest. These aren't just companies in their own right. I could see a lot of these things playing out over the time to come. So that's really that passive idea.
Yeah, I mean, one could argue that a corporation in its initial incarnation was like, the crown would, give, the right to some group of investors, like, okay, you can form a corporation in the public interest to go do some XYZ thing. But then we had limited liability, like we evolved the meaning of that. And now you're saying we didn't necessarily find like the final version, like that meaning can evolve further.
But we're very far from the final version of that. I mean, we haven't even looked into like AI companies and agentic corporations.
Right.
Like,
yeah, we're on the cusp of getting into the AI stuff, but just to hang on this passive flow stuff, if you don't mind, just for a second, like the I did see that it's so interesting. There's so many different perspectives that a person could throw at this, but it's like, on the one hand, people who've been concerned about inequality and all these things that you've been talking about, part of the reason is like only if a certain segment of the population actually owns stock, and they're the ones who've benefited from the central bank printing money, et cetera, et cetera. And so why not get everybody invested in the markets from a young age so everybody can participate in the dynamism of the American economy and the profits that the corporations produce? Like, it makes total sense. But then you look at it a little bit deeper, and this is something I've been personally thinking about for a while, is like the S&P 500. 500 seems like a big number, you know, but it's like there's like 30 million companies in America, businesses in America, right? And like there used to be like 7, 8,000 of them publicly traded. Then they started buying back their shares. Now there's maybe 4 or 5,000. You know, so those 500 aren't like the economy, right? As I think you mentioned. But they're like the elite of the elite. You know, and what you're doing is you're getting everybody invested from birth in the most elite of the elite institutions, um, and kind of guaranteeing that their equity will always have a demand. You know, every time a baby is born, there's a new demand for the equity of these 500 elite of the elite, which is like a crazy thing. But that's sort of why the S&P 500 just kept going up, while in the pandemic, people's businesses were shutting down and people were like losing their filing for bankruptcy on in their personal businesses. But the stock market kept going up, and for me at least, that really broke this illusion. A lot of times people will say like the stock market is an indicator of the economy, where it's like I'm seeing the economy over here, everything's like nothing's moving, and then the stock market's just skyrocketing. Like clearly that relationship is broken down. Um, so it's interesting. I don't know. I don't want to say right or wrong, because you want everybody to participate in the dynamism of the economy, but you're also giving guaranteed demand to the most elite institutions that make it into this vaunted S&P 500 index list. Once you're
Well,
on the list, you have a guaranteed demand for your equity. Yeah,
what I would add to that is that if we do, in fact, get to a point in time where the government does have a substantial equity stake in these businesses, make no mistake that that is no different than a tax. If a government goes in and starts buying up large stakes of corporations, that is a tax. That is a very that is a definitional tax on that corporation's profits, right? In the circumstance that I described, where we might have fiscal dominance pumping tons of money into the economy, and then we look at the Kalecki levy equation, and we understand that that money ends up flowing into corporate through their income statements and onto their balance sheets, and then the government is opposed to a tax outright in the way that you and I understand taxes today, but that let's say some future millennial government might want to affect some sort of collective ownership. That collective ownership is the tax. It taxes the company and it pulls those profits out of the company and sends them to whoever the government wants. And so we are getting to that solution, but we're getting there in a way that kind of feels a little bit foreign from where we've been over the last 40 years, let's say.
totally. All right, so we finally made it. We have covered the 4F's. Sorry if that took a little while. Hopefully you're not too exhausted, but we're in the home stretch here. So let me see if I can put it together, and you tell me if I have gotten anything wrong or am I missing something important. There's fiscal dominance. So the U.S. government, this giant behemoth of an apparatus with so many different heads to it, and the Treasury obviously is where all the money is kind of sitting, is playing a bigger and bigger role through directly pumping money into the system in terms of being a prime mover of the economy, more and more relative to the private sector, to bank lending, things like that. As part of this, there are like a few corporations that are really privileged because what they do, their size, their scale, their cultural influence, et cetera, all these things make them like very central to like almost this like chimera is forming between the government and these organizations. And it's not like one outright controls the other at this stage, but they have a very powerful kind of symbiotic relationship, which gives those corporations a very privileged status in the economy, too big to fail, you know, in that kind of a thing. But these are like tech companies and infrastructure companies, not like banks. Okay, that's fiscal dominance. Then financial repression is in this world where the government is putting more and more money into the system and being a prime mover of the economy. Interest rates are artificially capped in order to, from where they otherwise would have been, to kind of which will spur more private investment in the real economy. So now you have the government coming in and then private investment through lower than natural interest rates. So you have just a lot of force coming into the economy and moving things. And then you have this crazy thing with fiat money, where we're going to like program money potentially in such a way that the government can really create all kinds of new incentives to like make things happen and gain a lever that they've never had before, really, to incentivize the kinds of behaviors they want. And then we have these passive flows where it's like people are working in the economy, they earn their income, and a chunk of that just automated gets funneled into index funds. It's not really, less and less is the sort of, intrepid hedge fund manager who's like reading balance sheets and studying income statements and trying to figure out where the alpha is. That's less and less and less of a factor in moving things. And it's more just like the 23rd of the month hit and Vanguard or BlackRock had to like rebalance their portfolios and money moved around, or whatever. And this is the kind of system that interlocks in all kinds of interesting ways. Very different from whatever you may have studied in an economics 101 textbook or in a business school. But this is how you see the world today. And correct me if I got anything wrong there, but you basically see this as a transition phase to springboard us into a new kind of society, actually, like a new world that our technology is creating. So could you explain a little bit about why is it that this kind of weird system has emerged? What is it in preparation for? Like, why now are we living in this kind of a system?
Yeah, definitely. That's a really, you did a great job, by the way, in summarizing that, the 4F's. So right on, okay. But what is it all about? Like, to what end, right? And so what I see happening here is the suppression of volatility, right? I spoke about it before, and I don't mean about the suppression of financial markets volatility. I mean about the suppression of systemic volatility, right? I'll put it this way: if not for COVID, right? If not for that episode, which did result in one of the shortest recessions of all time, if not for that, we would not have had a recession since 2008. Okay, and that was a completely exogenous event that when COVID hit. If you look at the history of the United States, it's riddled with recessions, absolutely riddled, and yet, if not for COVID, we would have been on one of the longest stretches of all time without recession. Now, I think what's happening here is that we are seeing the positive side of the suppression of volatility, right? It hasn't, and I don't mean to, it's positive for the systemic sense, not positive for everybody. Obviously, a symptom of that is the inequality we spoke about, but maybe we could do something to help fix that. But anyways, the idea here of this suppression of volatility sets the stage almost like a substrate from which we can now start to birth, in a very literal sense, an AI-powered economy, right? A lot of if we can run the system at a kind of a stable level, then from that, AI can start to go into different parts of the economy and really start to change things. You can't really do that in a state of flux because all of the economic indicators that you're watching are going to be completely scrambled all over the place. You need a stable system state from which to do this. If you think about what AI is going to start doing, for example, to economic indicators, GDP starts to become irrelevant, unemployment starts to become irrelevant. You simply cannot birth AI from a period of flux because you're already in flux. You don't know, like there's no North Star, for example, right? If you can stabilize the system, then you can start to change aspects of it here and there and slowly degrade the value of those symbolic measures over time. So right now, for example, I was looking at the unemployment rate of bachelor's degree 20 to 25-year-olds in the United States. And it's just been slowly escalating over the last year. And the story right now is that, is that a function of AI replacing the low-end white-collar, like entry-level worker? That's the stage of AI right now. When we get ChatGPT-5 later this month, which is supposed to be PhD-powered, maybe we start to move that. Maybe we start to see an increase in the unemployment rate of graduate degrees workers, right? We'll see. But these are some of the signposts that no longer carry the same economic weight. Like if we had seen that 10 years ago, that's a massive red flag, and we have to do something about that. But this has been happening for over a year, and nobody's really batting an eye at it, right? Let alone what starts to happen to, well, if the unemployment rate starts rising from the prevalence of AI, what happens to the Fed's dual mandate, right? Your entire half of the Fed's purpose starts to become irrelevant, let alone if inflation does in fact start getting sticky up above 3.5, that 2% target's long gone. And we've already seen, papers, et cetera, from the Bank of International Settlements. Like the central bank of central banks has already been talking about removing or changing the inflation target that banks have kind of imposed upon themselves. So you are entering a world where things are already going to be changing in ways. And so you need to make sure that the foundational aspects of the economy, for example, pumping out a consistent amount of money no matter what, year after year after year, so that you can kind of train yourself off of that foundation, that substrate, so that then you can let the AI start doing more and more things. So that's really what I see the purpose is at this point. I don't want to get too far out talking about it to the distant future of things because it's just so inherently unknowable. I mean, there's all sorts of ways this could combine and connect and permutations, et cetera. But like for me, this is the most relevant near-term aspects that I've been looking
Uh, yeah, I mean, you're right that if unemployment rates among graduates were creeping up in the way that they are, it's obviously creating frustration among the young people for sure. But there's no shock to the system, it seems, in the same kind of way. Um, what well, are you concerned a little bit about this system? There's obviously benefits of stability. There's benefits, the state being more and more involved in the economy means there will be stability. There will be a kind of constant source of demand that you can count on to some degree, right? Because, it's the government. They have a lot of power and resources, etc. But the flip side of that is the trade-off is like the government is more and more involved in the steering of the economy. And are you concerned about like the infantilization of the public to some degree in this kind of system where it's like, um, yeah, does that make sense what I'm asking there?
Yeah, I understand. Like the degree of agency becomes removed from the private sector. Is that kind of what you're getting at?
Right. I think in your writing, exactly. In your writing, you said like one of the goals of this is to reduce discretionary volatility, meaning volatility in financial markets, volatility in the economy, or whatever that comes from like agentic individuals making decisions, that
Yeah.
gets just wiped out because now the government is just backstopping everything. And that's great. Keeps things stable. But does that kind of infantilize us? Does the government become this like super paternalistic entity and we kind of just live and the policy, all the discretionary volatility rises to the level of the policymaker. If the policymakers like electric cars, all of a sudden electric cars get a ton of money. If they don't like electric cars, then they go somewhere else. And it's like we're just kind of sitting here. It's like, or whatever they decide, we'll just like run or scurry over there and try to like catch the money falling out of the sky.
Yeah,
Is that
yeah.
kind of what you see? Yeah.
No, I get. There's this kind of like trepidation of the managerial class just taking over everything, right? And I think that's kind of like the kind of risk or the worry or the anxiety that would be created in a system like this. But I think what that view discounts is the increasing role that managerial class itself is being replaced by AI. I think that if there is one class of economic actor that is most likely to be removed from the equation by AI, it's that. Okay, and sorry to be so blunt about it, but like that, like in my view, that's really where AI is going. That's the bread and butter. That's the meat and potatoes. If you look at AI from a cost savings perspective, who is it that AI is replacing in the workforce? It's replacing those people who are commanding large incomes, pensions, benefits, etc. That's where you're going to get the most bang for your buck if you're a CEO trying to install like agents, right? There are some public companies, and that's their entire business model now, is helping companies remove the managerial class and replace it with AI, right? And it is starting with the low end, as I said, but like I said, GPT 5 debuts in a couple of weeks, right? And so you got to be on the lookout. So I do understand that concern. I don't mean to dismiss it. I get why people would be concerned about that, but I do think that this infantilization idea, I don't think it's going away. I don't think it's something that we could stop even if we tried at this point. Like the benefits and the trajectory of AI being where it is right now, I think it's like, just to be able to, from my perspective, invest in a world that is already dealing with this and see where that's becoming most effective and get on board with that trend. That's, from my neck of the woods, that's how I'm seeing this, create opportunities at least.
That's very accepting reality. I respect that. Maybe we can close out here then. What do you see as the role for human beings in terms of participating in this system? What parts of the economic system do you think, when this all plays itself out, do you think will still be relevant in? And since you think that we're going to be just needed less and less, like what do you think like a human being, and there will be this abundance kind of economy where we'll have access to all these things. It'll kind of run on a kind of autopilot or a kind of a formulaic way. What do you think is like people will do with their lives? Like how will we make sure we don't like regress in our own abilities, mind and body? Like how do you think human beings should still continue to grow? Because I think a lot of the growth of human character and personality and intellect and all that was driven by the need to be able to participate in an economy and do those kinds of things. Like, where do you think that'll come from?
Yeah, I think that those very real human emotions and feelings and purpose actually amplifies under that framework. There's a very real concern that AI will put everybody out of work and that humans will lose their purpose, and we end up in this kind of mass cultural depression because nobody has anything to do. That's not a future that I see whatsoever. I think that if we were to give everybody 8 hours of their day back, we'd find a massive amount of productivity. Maybe not something that you could measure in the sense of GDP, but if you were to spend more time with the people that you loved, like work from home did for a lot of people, and was a massive net benefit for a lot of people, a lot of families, a lot of millennials specifically with young families being able to spend that time with their kids, working from home. But we scaled that out and we kind of made something like that quasi-permanent as more and more AI could go out there and do its thing. I think that there would be a massive net benefit to society, maybe a reconnection even, right? We've all been sort of desensitized through phones and everything, and deconnected and all this kind of thing. And what if there was a way to reverse that? And that just meant spending more time together as people and not necessarily as workers, right? And I'm not saying that we're going to end up in this like abundant world where you push a button and you get everything you want. I mean, that's crazy, and that's never going to happen. That's just not what this means. Post-scarcity just means that the connection between your labor and your time and the money, those things are no longer scarce. Money is no longer scarce in that way because now the government is the source of the money. Labor is no longer scarce because we can make machines that do the labor. Your time is no longer scarce because you're no longer a worker who has to punch a clock for 8 hours a day in order to make the money that you have to so that you can live the quality of life that you want, right? And so if we can start dissolving some of those tethers, then I think that humans can find all sorts of interesting new ways to spend their time with the people that they love, doing what it is that they love. Obviously, some people, it's not going to be great for everybody, but nothing ever is. But I think for the vast majority, this could be a really great experience if we could all, align with that idea, right?
Hopeful. Thank you, Ben. Thank you for your time. This was very thorough, so I appreciate it.
You're very welcome. It was my pleasure. And just a note out to your audience, if there's anything I said in here that you have an issue with or that you think is really great, please put it in the comments. I really want to hear from you. Like, I want to know more and more and more about what everybody thinks about these ideas, because ultimately it helps me to make this a very public discourse. So thank you so much for listening.
Thank you.